47 claims a week. That is your caseload. You are 24 years old. Your title is Property Claims Adjuster. Your salary is $41,200 a year. You work for a regional insurer that processes approximately 940 claims per week across a territory covering 4 states. You are responsible for 47 of them. You will deny 31 of them this week. You denied 28 last week. The week before that, 33. The denials are not arbitrary. Each one is supported by policy language. The policy is a contract between the insurer and the insured. The contract is between 64 and 92 pages long, depending on the product line. Most policyholders do not read it when they buy it. Most policyholders read approximately 3 pages of it when they file a claim and discover that the coverage they believed they had is not the coverage described in the document they signed. This is the call you are on now. The homeowner is 53 years old. He has held this policy for 11 years. His premium is $1,487 a year. He has paid $17,357 in premiums over the life of the policy and filed no claims. The water damage to his basement occurred after 3 days of rain. He believes it is covered. You have read subsection 3B of the policy. He has not. Subsection 3. B draws a distinction between stormwater and groundwater. Stormwater is water that enters the structure directly as a result of a specific weather event through a broken window, a compromised roof, an overwhelmed gutter system. Groundwater is water that rises through the soil and enters the structure through foundation walls, floor joints, or below-grade openings. The distinction is hydrological. It is also consequential. Stormwater damage is covered under the base policy. Groundwater damage is not. The exclusion is on page 14. The homeowner's damage is groundwater. You determined this from 3 photographs, 1 contractor estimate, and the hydrology of his address, which you looked up in the company's geographic risk database in approximately 4 minutes. You have been on this call for 9 minutes. He has been a customer for 11 years. The information asymmetry between you and him is total and has been total since the day he signed the application. You explain the distinction. You use the language the training manual recommends: specific, respectful reference to the policy document. You offer to send him a written explanation and the relevant policy language by email. He asks if there is anything he can do. You tell him he has the right to appeal the decision. You describe the appeal process. You give him the time frame. The appeal will be reviewed by a senior adjuster. The senior adjuster will reach the same conclusion because the policy language has not changed. You end the call. You document the outcome. The documentation takes 4 minutes. You open the next claim. You will think about the 11 years and the $17,357 for approximately 40 seconds. Then the next claim will require your attention, and the 40 seconds will end, and the ratio of denials to approvals this week will not change because of the 40 seconds. You are not indifferent to the homeowner. You are a function inside a system that was designed before you arrived and that will operate after you leave, and that requires the policy language on page 14 to be applied consistently regardless of the duration of the customer. Relationship, or the amount paid in premiums. This is level 1. This is where the system touches people. The policy is written to protect the company. The premium is paid by the customer. These 2 facts coexist without contradiction because the customer agreed to the policy at the point of purchase, which is a point at which almost no one reads the policy. The system was designed around that gap. 3 years later. Your title is Commercial Lines Underwriter. You are 27 years old. You no longer take calls from policyholders. You price the policies. Your salary is $68,400 a year. Your decisions affect approximately 4,000 active policies in your book. You did not design the actuarial models you use. You apply them. The distinction matters less than it sounds like it should. Underwriting is the process of determining what risk costs, not what risk is what it costs. The distinction between those 2 things is the entire business model of insurance. Risk is an event that may or may not happen. The cost of risk is a number that can be calculated with reasonable precision from historical data and applied to future policyholders before any event occurs. The underwriter's job is to ensure that the premium collected from any given policy exceeds the expected cost of claims from that policy, plus the overhead of administering it, with sufficient margin to remain solvent if claim rates exceed the model's predictions. The model uses several hundred variables. Zip code is among the most significant. Not because of anything about the individual applicant, but because claims in a given zip code create a historical record that predicts future claims in that zip code. If your neighbors have filed significant water damage claims in the past 5 years, your premium is higher than it would be in a zip code where your neighbors have not. You did not cause those claims. You did not choose your neighbors. You live at a specific latitude and longitude, and the historical loss data at that latitude and longitude is priced into your renewal notice every year. A homeowner in a flood-adjacent zip code in a coastal state pays a premium that is on average $2,214 higher per year than an actuarially equivalent homeowner in a low-risk zip code. The two homeowners have identical credit scores, identical home values, identical claim histories. The difference is the address. The address is a proxy for a group statistical risk that neither of them individually represents. The system cannot price individuals. It prices populations and applies the price to individuals within those populations. You price a policy for a small manufacturing company this week. The company has operated for 14 years with no claims. Its industry classification carries a moderate loss history from other companies in the same classification, not this company, other companies with the same SIC code. The actuarial model produces a premium of $47,800 a year. You review the file. The company's safety record is notably clean. You have discretion within a band of plus or minus 12%. You apply a 7% reduction. The final premium is $44,454. The owner accepts it. You have never met the owner. You will not meet the owner. You have not read the OSHA reports or visited the facility or spoken to anyone who has. You have read a classification code, applied a model, used your discretion within the permitted band, and produced a number. The number is the relationship between the company and the insurer until renewal. The company will file a claim in 22 months. A piece of equipment will fail. The claim will be $743,000. The policy will cover it. The underwriting model, run again at renewal, will increase the premium by approximately 31%. The owner will call a broker. The broker will shop the policy to 3 competing insurers. All 3 will receive the same claims data. All 3 will apply similar actuarial models. The lowest quote will be $41,200, which is still significantly higher than the $44,454 you charged. The owner will take the lower quote. You will not be told any of this. The file will simply close at renewal. Insurance does not price individuals. It prices populations and assigns those prices to individuals who happen to share a classification, a zip code, or a claims history with other people they have never met. The premium you pay is a group statistic with your name on it. The group is real. You are an approximation of it. Your title is Senior Property and Casualty Actuary. You are 31 years old. You hold a fellowship from the Casualty Actuarial Society, which required 7 examinations over 6 years, and which is the credential that permits you to certify the reserve adequacy and pricing adequacy of an insurance company's products. Your salary is $112,000 a year. You do not price policies. You design the models within which policies are priced. You do not adjust claims. You calculate the probability that claims of a given type and magnitude will occur. The distinction is foundational. The central metric of your work is the loss ratio. The loss ratio is the percentage of earned premium that is paid out as claims. If an insurer collects $100 in premiums and pays $62 in claims, the loss ratio is 62%. The remaining 38% covers operating expenses, commissions, overhead, and profit. The combined ratio loss ratio plus expense ratio determines whether the company is profitable on its underwriting operations. A combined ratio below 100% means the company is profitable on underwriting. Above 100% means it is not. The target loss ratio for the homeowner's product line you are responsible for is 58%. This is not a goal, it is a design parameter. The product is designed, priced, and distributed in a way intended to produce a 58% loss ratio at scale. This means that for every $100 a homeowner pays in premium, the expected design output of the product is $58 returned in claims. The other $42 is the cost of running the system and the return to the company's shareholders. The 58% target was set through a process that examined historical loss ratios across comparable product lines, competitive premium levels in the market, the company's expense structure, and the return on equity required by the capital allocation the product line consumes. The target is not arbitrary. It is also not negotiable in any given year. It is the number the product needs to produce for the company to remain solvent, competitive, and profitable simultaneously. You design a new endorsement this quarter. An endorsement is an optional coverage that can be added to a base policy for an additional premium. This endorsement covers service line failures, underground utility lines, connecting the home to the municipal supply. It is priced at $97 a year. The expected loss ratio for this endorsement at scale is 41%. This is significantly below the homeowner's product target and significantly more profitable. The endorsement will be offered at point of renewal. A significant portion of policyholders will add it without reading the coverage description because it is presented as a protection against a specific risk that feels real and is priced at a level that does not require deliberate evaluation. You know the 41% loss ratio. The policyholder does not. The policyholder knows the $97 and the coverage description. The coverage description is accurate. The loss ratio is not disclosed on the renewal notice. It is not required to be disclosed. It is the internal design parameter of a product that was designed to be profitable, which all products are designed to be. The disclosure of profit margins on insurance products is not required by the regulatory framework in any jurisdiction in which this company operates. You present the endorsement to the Product Development Committee. The committee approves it. It will generate approximately $14 million in premium across the book in the first year. At a 41% loss ratio, it will pay approximately $5,740,000 in claims. The difference, $8,260,000, will cover commissions, administrative costs, and margin. The committee notes the endorsement as a successful product development initiative. You return to your desk. You open the next model. The actuary's job is not to prevent loss. It is to ensure the company collects more than it pays, with sufficient precision that the business remains solvent across all reasonable scenarios. This is not a hidden motive. It is the stated function of the role. The insurance product is not designed to make policyholders whole. It is designed to make policyholders whole at a cost that is less than the premium collected from them in aggregate. Both things are true simultaneously. The product depends on this. 11 years after the desk. Your title is Chief Financial Officer. You are 35 years old. You have worked inside the insurance industry for 11 years across 4 roles. You now sit at the level where the business model is fully visible, not the claims, not the pricing, not the actuarial tables, but the mechanism underneath all of them that makes the entire structure coherent. Insurance companies are not primarily in the business of managing risk. They are in the business of managing money. The risk management is the acquisition strategy for the money. Understanding this distinction changes how you read everything above your level. When a homeowner pays a premium of $1,487 in January, that money does not sit in an account waiting to be paid out as a claim. It is invested immediately. The company holds approximately $2.4 billion in investable assets at any given time. The accumulated premiums collected from policyholders across its book, minus the claims already paid, minus operating expenses, minus reserves held against known outstanding claims. This pool of money, the float, is invested across a diversified portfolio of bonds, equities, and alternative assets. Last year, the investment portfolio returned 4.1%. On $2.4 billion, 4.1% is $98,400,000 in investment income. The underwriting operations last year produced a combined ratio of 97.3%, meaning for every $100 collected in premium, $97.30 was consumed by claims and expenses. The underwriting profit was 2.7% on earned premium of $1,400,000,000, approximately $37,800,000. The investment income was $98,400,000. The company's total pre-tax income was $136,200,000. The investment income was 72% of it. This is the architecture. The homeowner paying $1,487 a year believes he is paying for protection against the risk of loss. He is paying for protection against the risk of loss. He is also providing the company with approximately $1,487 of investable capital for the duration of the policy year, in exchange for which the company pays him nothing. The premium is simultaneously the price of insurance and the cost of a loan the policyholder does not know they are making. This structure was identified by Warren Buffett in 1967 when he acquired National Indemnity Insurance and used its float to fund his investment operations. He described the float as money the company holds temporarily and can invest for its own benefit. Berkshire Hathaway's insurance operations now generate approximately $168 billion in float, which is invested across a portfolio that has compounded at rates significantly above the market average for approximately 6 decades. The insurance industry at large operates on the same model, at varying levels of sophistication. The policyholder is not deceived. The premium charged covers the expected cost of claims. The investment income is not taken from the policyholder. It is generated by investing their premium while holding it before claims are paid. The policyholder agreed to pay the premium. The policyholder did not agree to invest in the company. They did not need to. The premium arrangement, as structured, accomplishes both simultaneously. You sit in a quarterly earnings review. The investment committee presents the portfolio performance. The underwriting committee presents the combined ratio. You present the consolidated income statement. Everyone in the room understands the relationship between the two lines. The word insurance does not appear in the meeting agenda. The agenda says Financial Performance Review. The title is accurate. The insurance company does not make most of its money from insurance. It makes most of its money from investing the premiums it holds before paying the claims. The policyholder is not a customer of a risk management service. They are also an involuntary source of investment capital. Both functions are real. Only one of them is on the product description. The homeowner is still on the phone. He is 53 years old. He has held this policy for 11 years. He has paid $17,357 in premiums. His basement has 4 inches of water in it. The water entered through the foundation wall over 3 days of heavy rain. This is groundwater. Page 14, subsection 3b, says, groundwater is not covered. You have told him this. He has not fully processed it yet. What he does not know, sitting in his basement on a Thursday afternoon, is the system visible from the other end of the phone. He does not know that the policy language on page 14 was written by attorneys whose job was to minimize covered losses within the bounds of regulatory requirements. He does not know that his premium is currently sitting in a $2.4 billion investment portfolio, earning 4.1% annually while his claim is being denied. He does not know that the denial of his claim contributes to a loss ratio that was designed at 58%, and that his 11 years of no claims history has made him exactly the kind of policyholder the actuarial model values. Most someone who pays without collecting. He will appeal. The appeal will take 60 days. The senior adjuster will review the same policy language. The outcome will be the same. The appeal decision letter will be 3 pages long. It will be accurate. It will be written in language that leaves no ambiguity. The ambiguity was in the purchase, not the denial. He will hire a public adjuster for his next claim. The public adjuster will know which words to use when describing the nature of the water damage. The public adjuster will know the difference between how groundwater is defined in the exclusion and how the entry point of the water can be characterized in the claim narrative. The public adjuster charges 10% of the settlement amount. He will earn that 10%. The policy language will not have changed between this claim and the next one. The subsection 3B distinction between stormwater and groundwater will be the same. The exclusion will be on page 14. What will have changed is the person reading it, or, more precisely, the person explaining it to the insurer on the homeowner's behalf. The system was not designed to be navigated without knowledge. It was designed to be a contract that most policyholders will not read, priced by models that most policyholders will not understand, investing premiums in portfolios that most policyholders do not know exist, paying claims at a ratio that was decided before the policyholders bought the product. The system is legal. The system is regulated. The system works as designed. He will hire a public adjuster next time. She will know which words to use. The policy language has not changed. Only the person reading it has.